The relative strength index is the most popular indicator, but it's very lagging. Let's just take this move down. We're looking at the S&P 500 here. I mean, even from just here to here, that is a 5.5% move down in 9 trading days. That is a massive move in the S&P 500. Yet the RSI from this bar is at 37 and even like tracking down, it's still at 34. Coming down here, it's still at 30. It's not till we get kind of all the way down here at the bottom that the RSI starts to go, okay, hey, maybe this stock is weak. It takes too long. And you can change this. You can come into the settings of your RSI and lower the length from the default 14, let's say down to something like 5. But then you kind of just get this chop. And it's like, it really is incomprehensible. It's like, well, what does any of this chop even mean, right? What I've done is I've created a new study that I named Dual RSI. It consists of 2 lines, the cyan line being the default length relative strength index study of 14. The purple salmon colored line is a much faster reacting RSI with a shorter length of just 5. Once again, let's take a look at this move down. This once again sort of 8.5% move down in the S&P 500. When it gets its initial big red candle, the start here of this move, the default RSI, once again being the cyan line and number, is still at 46. It's really not reacted to this move yet at all. That is, once again, the issue of lagging within the relative strength index study. However, the shorter length 5 has already jumped all the way down to 28. Once again, I sort of showcased if you only have the 5 on, that doesn't really make a lot of sense. You end up with just a ton of noise, it's a ton of chop, and it's really incomprehensible. But having them both on lets you see visually, of course, that now the faster reacting RSI line is down and below the normal RSI line. That is what is signifying bearishness at a much faster rate than the typical RSI. And you can see it remains below, remains below, remains below for all of these candles until this candle here. So you save yourself 6% of downside by following the bearishness that is being plotted by this new dual RSI study. And that first study was just sort of a halfway point. What I've really fully built out here is a full divergence chart. This probably looks very similar to the MACD indicator. The MACD, of course, being the moving average crossover divergence. All that study is measuring is the difference between 2 moving average lengths. So I've essentially built the same exact code, but now for 2 RSI lengths. Once again, you can see those 2 lengths being plotted in these 2 lines, and now the histogram represents, if it is green, that means we are bullish, meaning the faster length RSI is above the slower length. Obviously, if we're red, vice versa, we're bearish, the faster length RSI is below the longer length. And of course, it measures the difference between the two. So the larger your histogram bar is, the more strong that trend is. So right here, you can immediately see we get a pretty large red histogram bar on this initial candle here. And you can see that then, of course, being the same move that follows through all the way down until here. Once again, you get that RSI cross, your MACD divergent sort of histogram chart here turns back to green. We're about to hop into building strategies that prove whether or not the study is actually useful. Just before we do, of course, this is going to be a lot more custom ThinkorSwim codes. I just want to let you know about my website, daytradingstrategies.net, where you can now access this new RSI crossover divergence study, as well as if we build a strategy that looks to have a good back test, maybe I'll publish that as well. Anyway, daytradingstrategies.net, linked in the description down below this video. So this is my first pass at it, the most obvious strategy that comes to mind. If I zoom in here, we can see what's going on. We buy when our RSI divergence turns green, we sell when it turns red. We're looking at the SPY daily chart here, so this would be for swing trading. And I mean, it's profitable, but it's far from a good strategy. This is why these back test labels are so important, because I can see from the statistics here that the max drawdown is 218%, which is way too high. This is just not a back test strategy that I would ever try to take to live money trading. Even though it's profitable, who cares? A max drawdown like this is not passable. Let's actually zoom through and kind of try to find where that max drawdown happens. This is a really weak period here. Let me zoom out and look out at this even bigger. Actually, you see, we go from like a big spike of profit here and we lose it all. And the SPY chart isn't even really doing a lot here. It sort of just gets hung up. Look at this here. This is a lot of like just crappy chop, right? Like you get the cross, you get stopped. You get the cross, you get stopped. You get the cross, you get stopped. You get the cross, you get stopped over and over and over. It happens again here. So obviously this strategy and this indicator does not work very well in non-trending markets. Let's see if we can fix that and optimize this trading strategy. Actually, I maybe just discovered something in my sort of clicking around while working on this code. Let's go away from the SPY chart and let's look at some more volatile names. Tesla, obviously a very volatile stock. I mean, of course, Tesla is also just super strong, so maybe this is a little biased, but also Tesla hasn't always been strong. I mean, there's years here where it's basically sideways and the strategy is still making money. Let's go look at another stock like DraftKings. This is just one that pops into my head because I like DraftKings a lot. Another stock that is definitely more volatile than SPY, and the strategy does pretty well. I mean, a max drawdown of 71% is still too high, but it does okay on DraftKings. That max drawdown definitely comes from here, by the way. I mean, the stock got kind of destroyed in this period of time, so that's where that max drawdown comes from, as you can see. Anyway, the point is, maybe it's not so much a strategy problem as it is a stock selection problem. Let me look into some ways that I can quantify this so that we can build a scanner, which will be part 3 of this video, to help us find the right kind of stocks we should be applying an RSI crossover strategy like this to. The study I've turned on now at the bottom of this chart is called beta. What this Greek measures is the difference in volatility from the current chart away from the S&P 500. So as we're looking here at the S&P 500 ETF, SPY beta is basically always 1. There are some minor discrepancies between the ETF and the SPX itself, but even when you're looking at it, like this looks dramatic, but it's still 0.98, or like up here is still 1.03. It's basically always 1. Now, if we go back and look at a chart like Tesla, you will see that our beta is pretty much, I'm sort of hovering here around 2.5. That's pretty much the average beta on a stock like Tesla. It is typically 2 to 2.5 times more volatile than the S&P 500. And once again, you can see the performance difference of this strategy on Tesla versus how bad it looks on just the S&P 500 index. This is my high beta scanner. The meat and potatoes filter of it is this custom study filter here that takes the average beta value over the last 30 bars and then says that a stock must have a greater than 3 value there in order to be returned in this list. In fact, you know what? I'll actually give you this scanner for free so that you can more easily find more volatile stocks for yourself. I will copy and paste the TOS share link down in the description down below. And if you don't know how to import share links, I'll show you how to do that at the end of the video as well. But let's take a look through some of these tickers. So number 1 on the list is QBTS. Loading in QBTS, we can immediately see the strategy looks much better. Up 52 grand, yay yippee, that's all fine and dandy. What I'm really worried about is lowering this max drawdown number. A max drawdown of 35%. Still not like lighting the world on fire with a max drawdown that high, but obviously much better. And you can see the beta over the last 30 days on QBTS, so over the last month, has been extremely high. The stock is much more volatile than the S&P 500. The next stock on the list is actually, oh, it actually just jumped up to the top. I guess it's trading more volume now. SBET. I know this ticker. This ticker is now the largest corporate holder of Ethereum, and they just started buying Ethereum, so it just got a massive spike. I'm going to guess the strategy sucks on this. And yes, it does. If I'm allowed to defend my strategy here a little bit without sounding too biased, just don't like try to trade a stock like this. This is like not real, right? This thing just got a ridiculous spike when they bought all that Ethereum a few months back. So obviously their beta went through the roof, but it's not like consistent. Like QBTS, this is a real consistent gainer. I mean, you can see for the last few months, this thing has been just growing and growing and growing and growing. It didn't just get a huge random ass like spike. I would avoid ever trying to trade setups like this that appear really on any scanner, unless you're building a spike scanner. But for any kind of scanner like this, if the stock is only on the list because of one ridiculous move, I would just avoid it. Anyway, let's go down to the third stock, NBIS. Once again, nice. You can see here a consistent multi-month gainer. Max drawdown sits at only 30% with a $21,000 profit. The next stock is RUN. Nice. Here's another one that's actually weak. This is actually a weak stock. Remember, volatility can go either way. Volatility can either be in strength or in weakness. But even during weakness, like even on a weak stock, only a 38% max drawdown and $45,000 of profit. It really seems like a strategy like this, using this RSI crossover divergence, really only thrives on these sort of much more heavy volatility type tickers. And listen, I can read the comments already. Oh, Trey, you're cheating. You know, you just found the specific types of stocks that work to make this strategy look good. Well, that's the point, right? Like that's the point of every trading strategy. There's never going to be a trading strategy that works amazing on every single type of ticker. Your goal is to find the type of ticker that your strategy works on, and having these backtest labels and the ability to build and customize your strategies like this makes that a just so much easier process. I mean, think of really all the testing you've seen in today's video, and we did it in what, 5-10 minutes here. This one normally, if you weren't using custom code, this much testing would take you months of time. Think about having to go through and find all of the examples of entrances and exits, and then updating the strategy, and then going and finding all the instances. How would you ever find that these stocks only work on volatile tickers if you weren't able to build a custom scan like this, also making use of code? Anyway, I'm getting off on a coding tangent, but the power of code is immeasurable for retail traders. But anyway, back to my central idea here. Let me stop ranting. That's the point. Like, you're supposed to find the types of stocks that your strategy works best on and only trade those types of stocks. The strategy doesn't need to, and once again, it's not supposed to work on everything. Build strategies for specific stock types and add that to your playbook of winning strategies. You all just got to see in real time the power of using code to build and optimize both trading strategies and stock scanners. If you are interested in accessing both the study and strategy from today's video, which you can see I've already added to the website, alongside over 150 plus other custom ThinkorSwim coded studies, scanners, strategies, conditional orders, etc., then head on over to my website, daytradingstrategies.net. You can even access a handful of free codes over on the site, and I mean completely free. I'm not going to ask for your credit card, your email. You don't have to make an account. Literally just click the link and you'll be able to access them. And actually, let me showcase with this TOS share link here how you import scanners so that you can import that one from the description as well, the high beta scanner we covered in today's video. Every single one of the 150 plus codes on the website comes with one of these TOS share links. All you need to do is copy that link back within your ThinkorSwim, set up in the top right, open shared item, paste, preview, and import. Just like that, in about 3 mouse clicks and 5 seconds, you can have any and all of the 150 plus codes from the website saved locally within your ThinkorSwim. So even if you decide to unsubscribe from the website, whatever, you will still have the codes. The codes are yours once you import them. Anyway, if you import a study or a strategy, you simply open them from the edit studies modal like you normally would. For whatever reason, when you import a scanner, ThinkorSwim pops it up in this little window. You can just close this out of the way. From your scan tab, click into this middle hamburger icon and then simply load in the scan however you normally would. This one, of course, being called the high beta scanner. You simply click on that to load it in. So once you import it, it'll be there and ready for you to load in just like you load in any other scanner. And right now for the month of August, I am running a limited discount code on the website. If you use code AUG30, you'll be able to take 30% off of anything you decide to sign up for. I set up 30 of these codes to be available for the month, of which there are now only 8 remaining. So the next 8 of you to use this coupon code will get 30% off. You can sign up for either the monthly plan or the annual plan. I do have my service set up as a subscription model because, as you just saw, I am always adding and updating codes on the website. There's no such thing as strategy study scanners that will always work forever. It's important to remain on top of ever-changing market conditions. That's why I set up my business model in this way. Anyway, sign up for the monthly, or you can sign up for the annual. Obviously, this is going to save you some money over the next 12 months of access to all the new codes I'll add to this website, but also, and more importantly, it grants you lifetime access to the Discord server. We are always, every single trading day, hanging out in this Discord server, talking about what stocks are moving. Even during pre-market, we fire up the conversation around 7 o'clock, which is when you can begin pre-market trading in Charles Schwab. I'm even sort of live streaming a scanner up here in the Discord as well, so you can have this to make sure that you never miss any moves that's going on. Currently, there are over 200. We just passed 275 members. It's really crazy how fast this thing is growing. That's a lot of eyes on the market. That's a lot of people watching the market and talking about what's going on. It's just a great way to ensure that you never miss a move. So obviously you get access to that at no extra cost, to also having 12 months of access to every new code I will add to this website. That's a ridiculous deal, even at $400. That is a ridiculous good deal. However, the next 8 of you to sign up, once again, using discount code AUG30, will be able to take even 30% off of that. That means you will get the 1-year access and the lifetime access to the Discord for less than $280. Anyway, daytradingstrategies.net, once again, will be linked in the description down below this video. Go check out the website. Listen, at least go take advantage of the free codes. Why not? They're completely free. Maybe while you're over there, read some of the reviews and help decide for yourself if this is something that could help accelerate your personal trading journey.